Ladies and gentlemen, Asian guy here. We live in a world of illusions. We have paper money that isn't money. We have news that isn't news. And in the silver market, we have an inventory report that is the greatest work of fiction since Harry Potter. For years, the bears and the bank apologists have pointed to one number to tell you that silver is plentiful. They point to the total inventory on the Comex. They say, look, there are 300 million ounces in the vaults. There is no shortage. You are a conspiracy theorist. But today, we are going to tear the roof off the warehouse. We are going to expose the dirty little secret that the CME group desperately hides in the footnotes. We are going to talk about the difference between registered and eligible. Because if you don't understand these two words, you're looking at a mirage and thinking it is an oasis. The truth is terrifyingly simple. The silver you see on the report is not for sale. The total inventory number is a lie designed to suppress the price. The real number, the number that matters, the number that determines if the market lives or dies, is flashing red. It is at historic lows. The vaults are not full. For all intents and purposes, the vaults are empty. Let's break down the scam. The Comex divides its silver inventory into two categories. Category 1, eligible. Category 2, registered. Eligible silver is metal that meets the purity standards of the exchange. It is a 1000 Oz bar, 0.999 fine. It is sitting in a Comex-approved vault like Brinks or Loomis. But here's the kicker. It is not for sale. It belongs to someone. It belongs to a private investor, a family office, a bank, or an ETF like SLV. It is just being stored there. It is like a car parked in a public garage. Just because the car is in the garage doesn't mean you can buy it. It belongs to the guy who parked it. Registered silver is the only metal that is actually available for delivery against a futures contract. It is the metal that has a for sale sign on it. It has a warrant attached to it. If you buy a futures contract and stand for delivery, this is the pile they take from. Now, let's look at the data. 5 years ago, the registered category was overflowing. There were 150 million ounces of silver ready to be sold. The market was loose. If you wanted metal, you could get it. But look at the chart today. The registered inventory has collapsed. It has plummeted. We are currently hovering around 30 to 40 million ounces. Let that sink in. 30 million ounces. In a global market, in a market where billions of dollars trade daily, 30 million ounces is nothing. It is a rounding error. It is less than 2 weeks of global mining production. It is less than what Samsung needs for 1 year of batteries. The registered silver is the buffer stock. It is the shock absorber. And the shock absorber is gone. We are driving a car with no suspension on a rocky road at 100 miles per hour. So why do the bears keep citing the total number, eligible plus registered? Because the eligible pile is still large. There are maybe 250 million ounces ineligible. They say, oh, don't worry. If the price goes up, the owners of the eligible silver will move it to registered and sell it. This is the fatal assumption. This is the lie. Who owns the eligible silver? Long-term stackers. Wealthy individuals who don't trust the banks. They aren't selling at $30. They aren't selling at $50. They are hoarding. ETFs. SLV. A huge chunk of eligible silver is actually owned by the iShares Silver Trust. It is legally ring-fenced. It cannot be sold on the Comex unless the ETF liquidates. It is double counted. It looks like available supply, but it is locked up in a trust. JP Morgan. As we discussed, JP Morgan flipped long. They moved their own silver into eligible to hide it. They are hoarding it for their own accounts. They aren't going to sell it to bail out a short seller. So the eligible pile is a mirage. It is a museum exhibit. You can look at it, but you can't touch it. The only thing you can touch is the registered pile. And the registered pile is being drained by the industrial whales we talked about. Imagine a supermarket. You walk in, the shelves look full. There are thousands of boxes of cereal. But when you grab a box, you realize it's empty. It's a display prop. You run to the manager. I need food. He points to a tiny shelf in the back corner with 3 boxes of real cereal. That's all we have, he says. The rest is just for show. The Comex eligible category is the display prop. The registered category is the 3 boxes of real cereal, and there are 500 hungry people in the store. This creates a leverage ratio nightmare. We track the number of open interest contracts, paper claims, versus the number of registered ounces, real metal. Right now, for every 1 ounce of registered silver, there are roughly 30 to 40 ounces of paper claims. This is a game of musical chairs where there is 1 chair and 40 people. As long as the music plays, as long as people trade paper, it works. But the moment the music stops, when people demand delivery, 39 people are going to end up with nothing. The vaults empty thesis is not hyperbole. It is a forensic accounting fact. The flow of metal has been one way, out. It is leaving the registered category and moving into eligible, private hands, or leaving the vault entirely, load out. Loadout is the final stage. This is when a truck pulls up to the Brinks vault in New York, loads the bars, and drives away. Once it leaves the vault system, it disappears from the data. It goes dark. We are seeing massive loadouts. This tells us that the buyers don't trust the exchange. They want the metal in their own possession. The illusion of plenty is maintained by the media and the banks to keep you calm. They don't want you to panic. If the world knew there were only 30 million ounces for sale, the price would be $100 tomorrow. Scarcity drives value, so they hide the scarcity behind the eligible mask. But we see through the mask. We check the daily warehouse reports. We see the drainage. We see the desperation. The emperor has no clothes, and the Comex has no silver. When you have cash in your hand, you assume you can buy what you want. That is the basic promise of capitalism. But in a broken market, cash is useless if the product doesn't exist. We are approaching the moment where your dollars will be rejected, not because they aren't legal tender, but because there is nothing to buy. The illusion is shattering. The registered inventory is the fuse. When it hits zero, or close enough to zero to trigger a panic, the explosion will be heard around the world. We have established that registered is running on fumes. Now we need to investigate the eligible pile, the 250 million ounces that the bears claim will save the market. Why won't it save the market? The answer lies in one word: encumbrance. In the world of high finance, nothing is simple. You might think that if a bar of a silver is sitting in a vault, it is just a bar of silver. But that bar might have a lien on it. It might be leased. It might be rehypothecated. It might be pledged as collateral for a loan. This is called encumbered metal. A massive percentage of the eligible silver is encumbered. This means it has multiple claims on it. Bank A might own the bar, but they leased it to Bank B, who used it as collateral to borrow money from Bank C. Who actually has the right to sell it? None of them. Bank A can't sell it because it's leased. Bank B can't sell it because they don't own it. Bank C can't sell it because it's just collateral. So this bar sits in the eligible column on the report. It looks like supply, but it is paralyzed. It is frozen in a web of legal contracts. If the price of silver spikes to $100, this bar cannot move. It is trapped. This is the encumbrance trap. The market assumes that high prices will unlock supply from the eligible vaults. But if 70% or 80% of that silver is encumbered, high prices do nothing. The supply is inelastic. Let's talk about the owners. We mentioned SLV, the ETF. The prospectus of SLV is a nightmare of legalese. But essentially, the silver in SLV is held by custodians, like JP Morgan in London and New York. This silver is often counted in the eligible Comex totals if it resides in New York. But SLV silver belongs to the shareholders. The authorized participants, APs, can only withdraw it if they redeem baskets of shares. It is not free float. It is investment grade hoarding. If the price goes up, SLV investors don't usually sell the physical metal, they sell the shares. The metal stays in the vault. It doesn't enter the registered category to help the shorts cover. Then there are the private whales. We know that billionaire investors and family offices have been moving silver into Comex vaults for safekeeping. Why? Because Brinks is secure. But these people are not traders. They are doomsday preppers with $1 billion. They bought that silver as insurance against a currency collapse. If the dollar collapses, which drives silver up, are they going to sell their insurance? No, they're going to hold it tighter. The higher the price goes, the less likely they are to sell. They are the strong hands. The shorts are betting that these owners will crack. They are betting that at $50 the whales will sell. But they misunderstand the mindset of the modern whale. The modern whale isn't looking for a 20% profit. They are looking for survival. They are looking to exit the fiat system entirely. You don't sell your life raft because the price of life rafts went up during a hurricane. We also have to talk about rehypothecation in the eligible category. This is the dark secret. It is rumored, and strongly supported by forensic evidence, that banks often count the same silver multiple times. Bank A counts it. Bank B counts it. Customer C counts it. This is fractional reserve banking applied to metal. It works fine as long as nobody checks. But in a delivery crisis, everyone checks. When 5 people show up to claim the same bar in the eligible vault, 4 of them are going to find out they own paper silver, labeled as physical silver. This is why the vault's empty thesis is so dangerous for the system. It suggests that the assets listed on the balance sheets of major banks simply do not exist. If the eligible silver is encumbered or rehypothecated, the net liquid assets of the banking system are overstated by billions. And look at the queue. When someone wants to move silver from eligible to registered to sell it, there is a process. It takes time. You have to get new warrants. You have to assay the bars. If a panic starts, the bottleneck isn't just the metal. It's the bureaucracy. The vault operators can only process so much metal a day. We could see a situation where there is silver ineligible that wants to be sold, but it is stuck in a 3-week administrative queue. In a super spike, 3 weeks is an eternity. The authorized participants, the APs, play a dirty game here. They often shuttle silver back and forth between registered and eligible to confuse the market. They move 5 million ounces into registered one day to make it look like supply increased. The price drops. Then, quietly 2 days later, they move it back to eligible. It was a head fake. They are painting the tape. They are managing perceptions. But they can't print metal. Every time they play this shell game, they lose a little bit of friction, and the registered pile keeps trending down. We are looking at a liquidity crisis in the physical underlying. The paper market trades billions of ounces a day. The physical market has 30 million ounces available. This divergence is unsustainable. The leverage is too high. The elasticity is too low. The encumbrance is too deep. The owners of the eligible silver are not the saviors of the short sellers. They are the enemies of the short sellers. They are the ones removing the chairs from the game. So when you see that 250 million eligible number, don't see supply, see a locked vault with a keep out sign, see a private stockpile that is preparing for the end of the dollar. The shorts are trapped in a room with a hungry tiger, the market, and a freezer full of steaks, eligible silver, but the freezer is locked and they don't have the key. They are going to get eaten while staring at the food. The encumbrance trap ensures that when the registered inventory hits 0, there is no cavalry coming over the hill. The eligible silver will sit there, mocking the shorts while the price goes to the moon. We have set the scene. The registered vaults are empty. The eligible vaults are locked. The industrial demand is raging. Now we arrive at the moment of impact. The train crash, the failure to deliver, FTD. And FTD is the nuclear bomb of the commodities market. It happens when a holder of ace-long futures contract waits until the end of the month, pays the full cash value of the contract, and demands the physical silver bars, and the exchange cannot provide them. How does this happen physically? Let's walk through this scenario. It's delivery month. A major industrial player, let us say a procurement arm for a consortium of electronics manufacturers, stands for delivery of 5,000 contracts. That is 25 million ounces. Remember, the registered inventory is only 30 million, so this one buyer is demanding 83% of the entire available stock in a single order. The shorts, the sellers, receive the delivery notice. They have to deliver the warrants. They scramble. They look at the registered inventory. They realize that if they deliver this silver, the vault will be practically empty. But they have no choice. They hand over the warrants. The industrial buyer sends the trucks. They want to load out. They don't want the silver to stay in the Comex vault. They want it in their own factory. The vault managers at Brinks or Loomis get the order. Load out 25 million ounces. They look at the floor. They see the bars. But wait, some of those bars are in the back. Some are being audited. Some have irregularities in the wait lists. They start loading, but they run out. They realize that the inventory count was optimistic, or worse, another buyer stands for delivery the next day for another 10 million ounces. Now we are at 35 million ounces demanded versus 30 million available. The math breaks. The vault manager calls the exchange. We don't have the metal. The exchange calls the short seller. You promised to deliver. Where is it? The short seller says, I don't have it. I thought I could buy it from the eligible pile, but they won't sell. This is the FTD. The contract is broken. In a normal business, if you sell something you don't have, you go to jail for fraud. In the Comex, they have a get-out-of-jail-free card. It is called force majeure, or cash settlement. The exchange invokes its emergency rules. They tell the industrial buyer, we cannot deliver the silver. We are declaring a force majeure event due to market irregularities, and we are voiding your contract. Instead of silver, we are giving you the cash equivalent at yesterday's closing price, plus a 10% premium for your trouble. Think about that. The industrial buyer needs silver to build products. They don't need cash. They already had cash. They used the cash to buy the contract. Giving them their cash back, even with a premium, is useless. It's an insult. It's like going to a bakery, ordering a wedding cake, paying for it, and on the day of the wedding, the baker hands you your money back and says, sorry, no cake. You can't eat the money, the wedding is ruined. This FTD event is the moment the paper price dies. Why? Because the industrial buyer now holds a check for $1 billion. They are furious. They are panicked. They still need the silver. Where do they go? They go to the black market or the street market. They call up miners directly. They call up private refiners. I have $1 in $1 billion. I need silver. I will pay whatever you want. The Comex price might be $30. But this desperate buyer is willing to pay $40, $50, $60. Suddenly, you have two prices for silver. The Comex price, the imaginary price of a paper contract that might settle in cash. The fake price, the street price, the price you actually have to pay to get metal in your hand. The real price, this is decoupling. Once the market decouples, the Comex becomes irrelevant. It becomes a betting parlor for paper speculators who never intend to touch metal. The real price discovery moves to the physical market, and the physical price will be multiples of the paper price. The FTD destroys trust. The entire futures market is built on the assumption that you can get delivery if you want it. That assumption keeps the paper price and physical price tethered together. If you prove that delivery is impossible, the tether snaps. Why would anyone sell silver on the Comex for $30 if the street price is $50? No one would. The volume on the Comex would collapse. The open interest would vanish. The casino closes because the players realize the game is rigged. This event will trigger a legal firestorm. Lawsuits, investigations. Where did the silver go? Who audited the vaults? But while the lawyers argue, the price will be mooning, because every other industrial user will see what happened. Oh my God, Samsung couldn't get delivery. I need to get my silver now before it's all gone. It triggers a bank run on physical metal. Every electronic company, every solar company, every battery maker will rush to secure inventory. The registered vaults will go from low to zero in 48 hours. The default isn't a single announcement. It is a process. It starts with delays. Oh, the truck is broken. Oh, the snowstorm delayed the shipment. Then it moves to partial deliveries. Here's 50% of your order. Wait for the rest. Then it moves to cash settlement. And finally, it moves to market failure. We are in the delays phase right now. We are hearing rumors of 3-month waits for large orders. The FTD is the next phase. And when it hits, if you are holding a paper contract, like an unallocated account or a general ETF share, you are going to get cash settled. You will miss the rocket. You will look at your account and see dollars. But when you try to use those dollars to buy real silver, you will find that the price has tripled. You were stopped out of your wealth by a default. This is why we say, if you don't hold it, you don't own it. The FTD isn't a glitch. It is the mathematical certainty of a fractional reserve system running out of reserves. The vaults are empty of free silver. They are full of claimed silver. And when the claims exceed the ounces, the default is the only way out for the exchange. But it is the way into poverty for the paper holder. So, the default has happened. The FTDs are public. The market is decoupled. We are now living in the world of unobtainium. What does this world look like? And what does it mean for you, the sovereign stacker? Unobtainium is a term used in engineering for a material that is perfect for the job but impossible to get. Silver becomes unobtainium. You will walk into your local coin shop. The shelves will be bare. The owner will shrug. I can't get stock. The wholesalers are sold out. The mints are on back order for 6 months. You check online. Out of stock. Notify me. Pre-order for 2027. The spot price ticker on the website might say $50. But underneath, in small red text, it says, we are buying at spot plus $20. We are selling at spot plus $40. The premium has eaten the price. This is the reality of a physical shortage. The paper price becomes a zombie. It walks around, but it's dead. The real action happens in the peer-to-peer market. If you have a monster box of eagles, you're now a central bank. Your neighbors, your friends, maybe even local businesses will come to you. I need to protect my savings. Will you sell me a tube? You name the price. You are the market maker. This is the ultimate vindication for the crazy prepper. The person who was laughed at for hoarding heavy metal bars is now the only person with liquidity. In a banking crisis, which likely accompanies the FTD, ATMs might be limited, credit cards might glitch, but silver is always valid. It is universally recognized value. The US banks, JP Morgan and the others who flipped long, will be sitting on their hoard. They will become the new supply cartel. They will trickle silver out to the highest bidder. They will prioritize Apple and Tesla. They won't care about the small investor. This creates a two-tiered society, those with access to strategic resources and those without. By stacking now, before the vaults officially hit zero, you are buying your ticket into the upper tier. The vaults empty scenario also has geopolitical implications. China and Russia will likely announce their true gold and silver reserves. They will say, look, the Comex defaulted. The West is bankrupt. We have the metal. This accelerates the death of the dollar. It accelerates the move to the BRICS currency. The empty vaults in New York and London become the symbol of the decline of the Western Empire, just like the empty grain silos of Rome before the fall. But there is hope. The price discovery that comes after the default will eventually stimulate new supply. At $100 or $200 an ounce, miners will open new mines. People will melt down grandma's silverware. Supply will eventually come back. But that takes years. The gap between the default and the new supply is the super cycle. That is the period of extreme wealth transfer. That is where we are heading. 3 to 5 years of absolute scarcity. During this time, your silver is not just an investment. It is freedom fuel. It allows you to bypass the broken banking system. It allows you to bribe your way out of a bad situation if necessary. It allows you to buy assets, land, homes, from distressed sellers who desperate for real money. The risk now is not price drops. The risk is counterparty failure. If you hold SLV, your counterparty is JP Morgan. If you hold a futures contract, your counterparty is the Comex. If you hold an unallocated account at a bank, your counterparty is the bank. If the vaults are empty, all those counterparties are insolvent. The only asset with no counterparty risk is the coin in your hand, the bar in your safe. It relies on no one. It needs no electricity. It needs no internet. It just is. The vault's empty narrative is the final chapter of the suppression story. First, they suppressed it with paper. Then, they suppressed it with rhetoric. Now, they are suppressing the truth about the inventory, but they cannot suppress the physical reality. When the vault is empty, the game is over. So ask yourself today, do you own silver or do you own a promise of silver? If it's a promise, redeem it. Take possession. If you can't take possession, sell it and buy physical. Because when the music stops and the FTD notice goes out, the promises will be worth zero and the metal will be worth everything. The vaults are draining, the trucks are moving, the clock is ticking. Get your metal out of their system. Because soon, even if you have a wheelbarrow full of cash, you won't find a single ounce.